Welcome to this week's market drama. We'll begin with the S&P 500, which was down 2% for the week. Year to date, still up 10%. NASDAQ was down even more, down 3% for the week. And the U.S. Barclays aggregate index was down 2% for the week. That's a pretty big move for the bond market in 1 week. If you look underneath the hood, what was driving both the stock and bond market action was the fact that the 10-year Treasury yield moved up higher, closer to 5%. This year, really what has driven a lot of the market action has been the fact that bond yields continue to rise for the Treasury market. And as to what was the instigator there, we had stronger than expected U.S. retail sales, 0.7% month-over-month growth. Those are stronger than expected number. They're not blockbuster numbers like we saw in 2022. For instance, we had a couple months in a row where we were seeing 1.5% month-over-month retail sales growth, but they were much better than expected. And that's 3 months in a row that we had strong retail sales, which means when we look at next week and we're expecting to see third quarter GDP numbers, we're probably going to see an annualized GDP number closer to 3% rather than 2%, which is well above the trend of 1.5% to 2% GDP growth that we've seen in the past. Why is this all relevant to the markets? Well, if the economy is holding up and actually doing fairly well, it is unlikely that inflation is going to come down. And if the economy is not in a deep recession, it's also then unlikely that the Federal Reserve will look at inflation and the economy and say, oh, now we're going to lower interest rates, right? They might actually say, you know what? Economy's holding up, inflation is not coming down fast enough. We might need to hike interest rates higher. Stock market does not like that, right? And that's where the volatility is coming into play. That is it for this week. Stay tuned for next week.